Welcome to My Money Mindset podcast, where we explore how a healthy mindset is the foundation for financial success. Each week, we delve into mindset hacks and practical strategies to help you enhance your income, help you make more appropriate investments for yourself, and to improve your overall financial well-being. Join us on this journey to transform your financial future by transforming your mindset. Please note that the information provided on this podcast is for general information purposes only and does not constitute as personal, financial or health advice. It has been prepared without considering your individual objectives, financial situation or life needs. Before making any financial or health decisions, you should consult with a qualified professional or financial advisor to ensure the information aligns with your specific circumstances. So let's begin and enjoy this journey as each episode teaches us on how to improve our overall mindset that overall improves our financial success. Hello everyone and welcome to another episode of Money Mindset. It's just in relation to consolidating debt and the importance of consolidating debt when you have so many repayments. Now, consolidating a debt really is generalized around maybe wanting to pay off a car loan sooner, pay off credit cards, personal loans, consolidate it within the mortgage or your mortgage debt, right? So particularly when you do roll it into your mortgage, as in that offers a few benefits because it can simplify the number of repayments that you have to make. So, and quite often when you may have, let's say, a car loan, a credit card, things like that, you've got 2 to 3 or 4 different repayments per month coming out of a savings account at any given time, and a lot of people sometimes it can overwhelm them. And what I mean by overwhelm them, they just see repayments coming out. It's harder to track. So for instance, you could have a personal loan with one bank, a car loan with another bank, and a credit card with another bank, and then a mortgage with another bank. And 9 times out of 10, generally speaking, the mortgage is always going to be a cheaper rate. And if you do have equity trapped in your property, then you can always use that equity to pay off the smaller debts and making it easier for you to manage your debt management. So what are the potential benefits for doing this? Well, simply, as I just said, was that the mortgage is generally a lower interest rate. So the most significant advantage is often securing a lower interest rate. So home loans always are typically lower, and the unsecured debts like a personal loan or car loan, or even credit card for that matter, are a lot higher. So by consolidating high interest debts into your mortgage, you can significantly reduce the overall interest that you're paying, right? Freeing up a lot of money and putting that money that you're freeing up back into the mortgage if you wanted to. So the savings that you're saving by consolidating that debt, sometimes, there's been instances where I've saved over $1,000 or $2,000 a month, and those savings can be thrown back into the mortgage. That will just smash your home loan down to pieces. If you can imagine $1,000 or $2,000, you're talking 24 grand. Recently just did one where it was 30,000 per annum saved. You just do the sums there. So 30,000 per annum saved on a home loan. You can just imagine how quickly that would help pay the home loan off, right? So there are massive reasons why you should be considering this as a serious strategy towards paying your home off and getting back onto a better financial sort of situation. It simplifies it, right? So you're not juggling around multiple debts. Now, having reduced monthly repayments, potentially that's what we're sort of aiming for because of the lower interest rate. Overall, the monthly repayment amount for the consolidated debt might also be lower to be able to sort of free up some cash, as in your cash flow. So for businesses or business people that use their house for their business to fund their business or anything like that, you could basically do the numbers and follow the bouncing balls. So for instance, if you're having a few bits of trouble with cash flow in your business or anything like that, and you're able to do this, God bless, it's one of the most fastest ways of of clearing up cash flow and not introducing other business loans into the equation. Now, a lot of people say, well, I can write it off because it's in my business and stuff like that. But the basic fundamentals of this is reduce the number of loans, and really, if it's got anything to do with a commercial or a business or anything like that, you really want to make sure that you're not just doing things to write it off on tax, but you're actually doing it to actually save money and to make money in business, right? So two different things. If I'm going to consolidate my mortgage and my debts into my mortgage on a personal level, there's no real tax advantages to this, maybe, then it just basically means I'm going to make a saving overall by consolidating debt, and those savings I can either throw back into the mortgage or put some of it in my pocket or do 50-50, whatever that may be. But in a business, sometimes the tax advantages, a lot of people just say, well, look, I won't bother with the consolidation of debts in my personal life and business life. Sort of, it's all a bit too much for me now, and I'm too busy and all that sort of stuff. But a good mortgage broker will always say, hey, I'll do the work for you. Where you've got to have a look at is make sure that your overall cash flow, so you are the owner of the business, you've got a few personal debts, you've got a few business debts, or want to increase your business debt and you write it off as, oh, it's a tax advantage. You want to make sure that the overall cash flow that's coming out of your pocket as an individual, because you are the guarantor for your personal life and the guarantor for your business life, business debt and personal debt all come back to you. So if that cash flow is affected because of either business or personal life, you want to make sure the overall debt consolidation strategy is making sense to both, right? So, and by all means, the other advantage of this is just to improve your credit score over time, right? So the more, by consolidating multiple debts, especially the high use of credit cards and stuff like that, that will cause, that'll really improve your credit file, because it reduces the number of inquiries, it reduces the number of outstanding loans or lines of credit that you've got out there, and then consistently making on-time payments, even for all your debts, then that's going to improve your credit score. So having a lot of debts out there, yes, you are playing a juggling act, but when you consolidate those debts, it makes it easier to manage, right? Which obviously is going to help with your credit score down the track. Now, potential to snowball payments. If you consolidate and then maintain your previous higher total monthly payments, right, like what I was saying before, the difference effectively becomes an extra payment on your mortgage, right? And this being one of the major reasons why you should consider this. But there also are some consideration and potential downsizes as well by doing debt consolidation. So it's not just a quick, let's consolidate, let's assess it. So what you've got to do is sort of speak with your accountant or broker, and then have a look at what is the benefits, or what are the potential downsizes. Potential downsizes that come off, sort of first thing that comes to my mind is a longer repayment term. So while the monthly payments might be lower, consolidating other debts into your mortgage extends the repayment term for those debts to the full mortgage term. So what I mean by that is, if your car loan has got another 3 years to go, by pouring that money back into your mortgage, you want to be aware and work the numbers out, because that mortgage is for another 20, 30 years, right? Your car loan's going to be paid out in 3. So you really want to make sure that what you're doing here makes financial sense. And I always say, when you're looking at what makes financial sense, it's in dollar signs, not in percentage signs. So many people go, well, what's the interest rate? And so on and so forth. What you've got to do when you're debt consolidating or finding out, trying to manage that cash flow or better repayments, is to have a look at the dollar signs that are coming out of your pocket, and also do a bit of a forecast to see what are the true advantages. You know, if your car loan's got 6 months to pay or something like that, work the numbers out on your individual sort of scenario, because it generally would mean that you're paying more interest overall, because you're consolidating that debt over that 30 years, right? So now, securing unsecured debt, when you consolidate unsecured debts like credit cards or personal loans, stuff like that, into your mortgage, the debts become secured against your loan. which this means if you default on your mortgage, your home is at risk of foreclosure in when you don't pay it off, right? So you got to make sure, once again, that the repayments make sense. Just because you can consolidate, let's say, unsecured debt, you've got to be really mindful that what you're actually doing or what you are consolidating makes financial sense to you, and it's to an advantage, not disadvantage. The other thing is to it, obviously, you're going to increase your mortgage balance. So that will affect your loan to value ratio, as in what they call the LVR, and could potentially impact your interest rate. Or you want to make sure that you generally don't want to go over an 80% loan to value ratio. And that means that the loan amount divided by what the value of your property is, you divide that and then times it by 100 will give you that LVR. And generally speaking, it should be buoyant under 80%. So buoyant under the 80% mark. So if it's 80% or less, then that's okay. If it goes over 80%, then you're going to be hit up for, most likely, for lender's mortgage insurance. Although that being said, some professions do get exempt from lender's mortgage insurance, right, with different banks. And also be aware that the additional fees and charges on your mortgage. So it's not a matter of just consolidating debt, and then when the fees and charges come on, you go, gee whiz, you want to make sure that you're fully aware of any fees that are associated. Once again, your mortgage broker will be able to tell you what they're doing, or the bank, and making sure that increasing your mortgage or such application fees, valuation fees, all this sort of thing, that all adds up. And make sure that if you want to be on a fixed rate and you've got to break that fixed rate, all that sort of stuff. So in summary, I just wrap this up by saying that consolidating debt into your mortgage can be one of the most powerful tools for accelerating mortgage repayment, or you want to pay a property off faster. So number one, it's probably a lower interest rate. Tick, bang, everyone wants that, even though the rates are coming down. I always say, don't be lazy, get onto it, speak to your broker, get him to chase. Top broker will always chase that interest rate and will be hungry to save you the bucks. And the reason why, good things go around, and if they're chasing to save you the dollars, it means that you're going to build your wealth off faster and not waste money. You can increase and free up your cash flow. I always say that cash flow is always going to be the blood flow of your well-being. So that being said, if you've got a healthy cash flow and look, money's going in and I'm saving as much as I can, and my financial wealth is great, your general outlook on life is always greater, right? So to make sure additional repayments into your mortgage principal, if you're consolidating debt and it's saving you a heap of money and you're able to pay the mortgage off faster, God bless. And especially if your mortgage, the value of your property is going up while you're paying the loan down, that's where I'm going with it. And there could that is where you introduce conversations of future investment properties, or future investments and stuff like that, because you're building the equity and the available of equity that you have trapped into your property. So it's win-win, right? And also you commit to not accumulating new debt. So what I mean by that is that the nature, once you learn, well, gee whiz, all my debts are sort of gone, they're all consolidating into one. The main thing for here is to be able to focus on one, and to be able to focus on not accumulating any other debt to go back to square one again, right? So once you consolidate, you get track onto where you want to go with life. You want to make sure that you want to pay the mortgage off faster, so you stick to that, and you do not, and you speak to your financial advisor or broker or accountant, whoever you trust in, for their advice as you're moving forward for your financial wealth strategies. And then you speak, look, what do I need here? Is it a good idea if what we're doing is what in accordance to what I want to do with my life? So speak to them about that. So before proceeding, it's always highly recommended that you do speak to a mortgage broker or financial advisor or your accountant, or all three of them, to assess your individual situation and determine if that debt consolidation is the right strategy for you. They can help you weigh out the pros and cons on your individuals. This episode was more about the briefing of what the advantages, but also what to look out for when you are considering that. So hope it helps, guys, and see you on the next episode.